Coface says the South African economy hasn't lived up to its potential over the past year. This has prolonged labour unrest and a weak demand for the country's exports saw growth fall from 3.8% in 2012 to just 1.9% last year. Coface's lead analyst, Sejal Singh, joins us now in studio. Sejal, thanks very much for coming through. Well, I was chatting to Mohammed just about the rand and the volatility we've seen and just the economic impact we're seeing from the strike at the moment. Do you see that as one of the big drawbacks that we have in the economy this year?
Yes, definitely it is. It's not just about output though. One of the major detriments to ourselves is the sentiment that it gives off, and we are detracting from that FDI, that foreign direct investment. Investors more and more becoming more cautious and more skeptical about our economy, and rather looking at the maybe higher risk markets such as the Nigerias, Kenyas, Mozambiques of this world. So that is the bigger problem. It's not just about the fact that we are not exporting as much as we should. It's the fact that firstly we're not capitalizing on our weak rand. As exporters we should be exporting more. It will be much more profitable at the moment, but we're just losing that investor confidence.
Do you think our labour force is more volatile than other emerging markets and other commodity producing nations?
Yeah, now that you say that, we've done a study to look at the next block of emerging markets, and predominantly the top 5 are in the East, and what we find is that the labour conditions there are much more suitable for business expansion and corporate expansion and global growth. You're looking at Africa as being firstly unskilled but very, very volatile, and that's what's the problem there. So when we have investors that want to look at a new economy, somewhere where they can invest in, they're looking away from the BRICS because people know exactly what the BRICS are about and the returns aren't as good as they should be. However, they now look at countries like Colombia, Peru, Indonesia, etc. So we are definitely missing something in that.
Mohammed, to what extent do you think that the elections this year have made it a tricky one for the government to perhaps take some of this labour unrest in hand, and that we might see things starting to settle down now that the elections are over and new cabinet comes into place and hopefully settles things a little bit?
It's an interesting question in that elections usually come with a lot of noise, a lot of rhetoric, and hopefully that should have passed. And unfortunately, given the outcome of the elections, we've got the rise of this left-wing party, the EFF, that's come into parliament and effectively gives them the ability to bring some of those radical elements or radical commentary into parliament. Now, I'll give you an example of that. Is they've been quite vocal around providing support for the striking workers until they get what they want. That unfortunately heightens the level of the rhetoric rather than causing it to calm down. I mean, effectively what we need here is we need a normalization in terms of labor relations. If you just look at South Africa, let's call it over the last 20 years, if you look at unit labor costs, so that looks at not only wage increases but also the commensurate productivity gains that are supposed to go with that. We've had unit labor costs escalating, I would pick a number at around 6.5%, almost 7%. Now that means that even if wages were growing in excess of that, there have been some productivity gains. It means that at 7% per annum on an annualized basis, I beg your pardon, we've been getting less productive than some of the other emerging markets out there. And I mean, if you look at the East specifically, they've got probably better trade linkages, they've got geographical advantages that we don't necessarily have. So we can sorely afford to have an unproductive labor market. And the problem, the last one here, is that a lot of the unemployed, we've got a structural unemployment problem, a lot of the unemployed are currently unemployable because of this massive skills mismatch relative to what this economy really needs.
So, I mean, do you think that we could face a ratings downgrade? I know that some of the agencies will be looking post the announcement of the new cabinet at perhaps coming for a review of our ratings.
Well, majority of the ratings agencies would look at ability to repay sovereign debt, and there I think there's a minimal chance of that. We are still well placed. Our markets are very liquid at the moment.
And we have low external debt, don't we?
Yes. However, looking further on, if the situation, especially in mines, because we're a major exporter, mining and agriculture are our driving the driving sectors of our economy. And if that doesn't improve by end of the year, then I would say yes, there's a huge chance for a ratings downgrade.
What are the biggest risks you see here at the moment, Sejal?
It's a number of risks, but the biggest risk is that people do not know how to compromise, and that's what it is, and that worsens the international sentiment. It just makes other markets more attractive, and that's where we are missing out on an opportunity. South Africa, in terms of infrastructure, in terms of policies, financial systems, legal systems, are miles ahead of any other emerging market, and that's including China, Brazil, huge economies of scale, but we're not capitalizing on that. all we are doing is casting ourselves in a negative light when we have labor unrest that shouldn't really be there, just because there's a lack of that ability to compromise.
Sejal, we have to leave it there. Thank you very much for coming through.
It's a pleasure. Thank you for having me.
Sejal Singh is lead analyst at Coface.